Probal, hi, morning. Thanks for joining in. We were chatting with Mr. M.K. Surana from HPCL as well, and he said that HPCL will have to align with the spike in oil prices. While they're comfortable for the month of Jan, they'll eventually have to figure out what to do for the supply when it comes to the month of February. That's a bit in a limbo. What, according to you, could be the repercussions of this oil price spike on OMCs?
Well, I think, one thing that's important to understand is that whenever a crude price spike happens primarily because of supply concerns or geopolitical issues, that's not necessarily met by an equal increase in product spreads. And I think that's where the problem is. Quite apart from, even securing supply, which is a very basic question. Current assumption would be that, supplies as such will not be affected to the point where you're running short of oil. But the fact is that this kind of a price spike means that the effective crude cost for all downstream players, not just the OMCs, for every refiner in this country, are expected to go up substantially without a corresponding increase in the downstream product spreads. So an already weak refining environment, I think, is expected, at least in the near term, to get even weaker. I think that is the more worrying development. I'm assuming right now that, given the state of global supplies, where there is a sufficient amount of spare capacity available in the system because of the voluntary cuts that have been in place for some time by most of the OPEC countries as well as Russia, you could probably see some more supplies being introduced if there is an actual conflict, or if this, state of conflict actually results in disruption of supply. But those supplies would definitely come at a higher cost, and therefore the refining margins for every Indian player, or every Asian player for that matter, are likely to see increased amount of pressure. And I think that is the bigger worry. In terms of earnings implication, I think every dollar increase in effective crude cost for the OMCs without a corresponding improvement in product spreads easily has about 12 to 13% earnings implication, which is negative. And therefore, given what we are seeing in the Indian environment right now, where even marketing volume growth isn't really running at very strong levels, I think operating earnings for the OMCs will remain exceedingly under pressure for the next 6 to 12 months.
Okay, that's the view coming in. But also, give us a sense as to how you see the overall situation now panning out. Given the fact that, we have seen crude oil prices at these levels, what do you believe that it means for our overall import bill were the prices to go higher if we do see the geopolitical tensions continuing to escalate?
So I think what's interesting is, if you look at the 9-month crude price average, for Brent right now, the 9-month average is at about $64. If I assume that for the next 3 months, crude prices will remain elevated at about $70, you're looking at an average price of around $66 or so. It's interesting to remember that in FY19, the average was still at about $70. So just on a pure average basis, the increase is not much, but obviously for FY21, if this trend continues, you can probably look at $70, $71 as the new normal, which is obviously not the most optimum level. The other part of it, you asked about the crude import. The net crude imports last year was in the range of around $90 billion. The 7-month average for this year is already at about $55 billion. So even before this price spike, you were looking at a 10% escalation in terms of the net crude imports for this year, for the country as a whole, at about $100 billion. If I factor this kind of price increase in, you're looking at another maybe $6 to $7 billion in terms of imports. Every dollar increase in crude prices is an effective $1.5 to $1.7 billion increase in our crude import bill. So from that aspect, I think the current account will probably see further pressure, and I think that's a broader macro negative for our economy, given how much of dependence there is in terms of crude. So on an overall basis, therefore, if this kind of situation, see, at the end of the day, the market is also really looking at the uncertainty, which is the most scary thing. It's not just about what actual impact the physical market will see. The market is obviously going to be pricing in the uncertainty that now exists in Iran, Iraq, and that entire region that suddenly seems to be flaring up. So till the uncertainty persists, if we are looking at a $70 to $75 crude environment, it's obviously not great news from India as from an import perspective or from a margin perspective.
Probal, the other thing is that, this could also really throw off the divestment process of BPCL. Do you think that that could also be a possibility? Because obviously the valuations, given the kind of impact that we are seeing on the stock prices, also are bound to get impacted.
Frankly, I would not be very comfortable commenting on what the divestment valuation would be, because at the end of the day, I think that's something for the due diligence. Deloitte, which is doing the due diligence, will have to factor in the fact that the next, at least in the near term, the next 12 months could be particularly difficult ones from a margin perspective, and they would probably want to factor that into whatever target valuations that they set for the company. At the end of the day, what the investor really has to keep in mind when they're looking at BPCL as a target is looking at the 10-year prospects. And any conversations we have had over the last several years is that the Indian oil marketing companies are valuable not only for their refining franchise, but also for the huge amount of marketing infrastructure that they have in place. And any interested investor would probably want to leverage that infrastructure and really build on that marketing promise that the Indian economy holds. So if one is looking at a 10-year picture, you would probably want to look at, okay, for the next couple of years, let me build in a weak margin environment, see what profitability looks like, and I will adjust my bidding interest, accordingly. I wouldn't necessarily say that the divestment process itself gets hit, but the amount of money that the government is looking to raise, that might actually see a slight downward revision if this, situation sort of persists for the next 3 to 6 months. That is definitely there.
Okay, and in light of the fact that we spoke to the management of HPCL, they say they will continue to align prices with international prices and continue to increase prices and exchange rate to impact the fuel pricing. What's the road ahead for some of these OMCs when it comes to the overall pricing trajectory?
Well, I think, as I mentioned earlier, it remains to be seen what impact these crude price impact has actually on international prices of gasoline and diesel. As I mentioned before, gasoline, diesel, or any other crude product price is more a function of the actual physical demand in the world, not just on the base product, which is the crude from which it is refined. So sometimes when crude actually is going up because of non-demand related issues, which is what is the case currently, I'm not too sure that gasoline and diesel would actually see a huge spike, at least in the near term. Yes, they do adjust with a lag. At the end of the day, product spreads are a function of crude plus the normalized spreads. But in the near term, what we are really seeing is, and that's why I mentioned that it's more a pressure on refining margins, because your product spreads might not actually go up proportionately. So your retail fuel prices may not need to actually escalate to huge levels, despite the fact that your crude prices have gone up so sharply. So all I'm saying is that obviously if pricing continues to go up, as we have seen in the past, when prices have escalated for petrol and diesel quite sharply, it has with a lag resulted in small, a break on the fuel consumption numbers, which is already fairly weak, at least for diesel. But petrol consumption actually has recovered quite nicely over the last 3 to 4 months. If prices were to escalate quite sharply over the next 3 months, you can probably see a pushback there as well. So your overall fuel consumption numbers in the country, which are trending at between 2 to 3% currently, you can probably see even more of a decline in those numbers, which is obviously a bit worrying from an OMC perspective, because as I said, refining margins remain weak, marketing margins remain at fairly decent levels, but if volume growth collapses, then there's very, very little levers for operating earnings growth, at least over the next 12 months for the OMCs.
Probal, great having you on the show today and, really getting a perspective on how the crude prices tend to impact oil companies back home. Good speaking with you as always.
Thank you. Thanks for your time.